This is Invisible Inc., the podcast for under-resourced women entrepreneurs. And I'm your host, Shubha Chakravarti, founder of Achieve. Join me as I talk to women entrepreneurs about the nuts and bolts of their journeys and to experts who will give you insights that are hard to find anywhere else. Let's jump in. What's the danger in following online startup advice as a new founder? How can you break the dilemma of not having the cash to hire the good lawyers you need so you can raise cash? And if you're a first-time founder, how can you find and leverage the sharpest legal minds you can find to help you nail your raise and beyond? In this episode, Elke Trilla, venture capital transactions and corporate governance attorney, talks about the hidden perils facing you as a first-time founder, the boring but game-changing details that can make or break your raise, smart ways to leverage your lawyer, and much more. Now, here's Elke. Hello, Elke. Welcome to Invisible Inc. We're so excited to have you here.
Thank you so much. I'm so excited to be here with you.
So I know you're pretty passionate about helping women founders, both as an investor and also as a corporate lawyer. Can you talk a little bit about how you got into this line of work? What's the most fun and rewarding part of it for you?
So I'm based up here in Boston. I am a Latina, and I spent most of my career working for major corporations, doing big transactions. I started out my career actually in public accounting, doing heavy tax work, a lot of cross-border work. I transitioned over and started doing mergers and acquisitions and working with public companies and private equity. I had dabbled with early stage companies throughout my career and really enjoyed it. But it was actually while on maternity leave a few years back that I got into angel investing, which really turned my eyes and my ears and my interest to working with early stage founders, especially women and folks of color, because it is just such an impossible journey for them without the right advisors and guidance early days. So it became a real passion of mine to take all my private sector corporate experience and share best practices and tips and tricks with these early stage founders.
So how long have you been an angel investor?
I'm an angel investor for almost 3 years now. Started out small and has really trickled into an exciting portfolio for me. I'm also an investor in a venture fund. I invest with syndicates and other cohorts, other female investors. So it's really exciting. I think there's a lot of great work happening in that space, a lot of new investors coming to the table.
So you talked about women and especially diverse women founders, topic close to, I think, both of our hearts. What have you observed both through your legal work as well as through your investing work with respect especially to fundraising and obtaining financing in general that you think characterizes the lives of women founders?
The numbers are egregious. Like, we all know how difficult it is to be a founder that doesn't come from that traditional background. There's so much to be said about having a nest egg or something to fall back on, right? So many of us who don't come from traditionally wealthy backgrounds would feel really risk averse to starting a company, right? Not taking a salary, not having a clear trajectory of when you'll have enough money in the door, not having benefits, et cetera, et cetera. And that comes to play throughout the life cycle of a company. When founders are going out and doing fundraising, they're so desperate to get access to capital so that they can grow and scale their company. But they also have the weight of the world on their back as far as needing to support themselves, needing to support family members, maybe elders, maybe children, siblings, et cetera, et cetera. It's just a really different playing field that those first-time founders are facing.
Is anything changing about that? I think we've all seen a lot of attention focused to your point about the low funding numbers we've seen for women, whether it's VC or whatever other source of financing. What's changing about this, and what are the trends that you're seeing specifically with regard to first-time female founders of color?
It's actually a pretty unique time. I think with COVID, there was a ton of money flying around, and for whatever reason, there were more investors coming to the table, right? Like there's all these great new fund managers who are starting funds, which is amazing. And then they're deploying capital in portfolio companies. Similarly, there's people that are taking their private wealth and investing in an early stage company. So I think there is a real underground movement happening when it comes to diverse opportunities to raise capital, which I think is really great. I know how important it is for people who actually are products of the problems they're trying to solve, understanding that market fit, right? Like, who is better to solve women's health problems than a woman? Who is better to sell the next great bra or workout wear for petite women or any size woman than a woman who fits exactly that profile? who is better positioned to create products for young parents, new parents, dealing with toddlers, working people than the people who are exactly in that space. So I think there's just tons of disruptive opportunities for both founders and investors to really come to the table, solve problems that they face every day, and find new ways to get capital, right? You don't always have to follow the same trajectory and the same VC funds to get access to capital and grow and scale your company. There can be other ways to do it. And I think there's a lot of new players coming to the table.
Which is an extremely pertinent point you made. Clearly, there was a ton of money that flowed into the VC system, as you mentioned, during the pandemic, and things have fallen off a cliff starting in late 2022. And we're particularly seeing that as we head into 2023. Any thoughts or comments in terms of implications for female founders as they look to raise capital in this new environment?
Stay focused. Stay focused on your product. Stay focused on scaling. Try not to get bogged down by the noise. There is a lot of noise in the startup community about how funding is drying up, how difficult it is to raise, how so many companies are going to fold. But I think we have to be honest with ourselves about what fundraising was like in the last 2 years during the pandemic. It was the heyday. There was so much money flying around. Valuations were huge. Individual check sizes were enormous. And that was a different time. I think founders will be successful in scaling their company and raising are those that don't need a $50 million first-time check in the door. They are able to scale and make do with the funds that do come in. They are able to hit the ground running and sell their business and meet new investors and bring the right investors to the table. Try really hard not to fall into the trap of negativity and noise that so much has been going around talking about how funding is drying up. Maybe the check sizes are not as big as they were in the last 2 years, but don't let that stop you from continuing to solve your problem, continuing to develop the product you're focused on, continuing to reach the market that you're trying to cater to. It can still happen for you, even when, the tides are shifting a little bit.
So it almost sounds like the fact that we've historically had to be scrappy can actually come to our aid because we've been forced to be frugal and do more with less. You mentioned being focused on your product, being focused on your strategy, being focused on your market. So what are some initial things that a founder needs to do when it comes to thinking about setting all of this up? How should she be thinking about corporate strategy? What are the things she needs to have in place? Can you talk a little bit about that?
I mean, there's so many materials out there on the internet for first-time founders that sort of give the false impression that someone can do this on their own, especially when you're thinking about the legal considerations and risk management, right? You want to bring the right people to the table, advisors that can really coach you early on in the things that you don't know. Inevitably, unless you went to law school and you have worked with startups for a number of years, you're not really going to be versed in how this goes and what are best practices and worst practices. So it's critical that you bring great advisors to the table that you trust, right? And advisors, like, it can't just be touch base once a year or even once a quarter. Early stage, while you're still developing the idea and the business plan, you really need to keep these advisors close to your heart and close to your business product so they can help you identify pitfalls that you might not even be aware of, help you manage risk, and ultimately help you put forward a corporate strategy and business strategy that will sit well with investors. That's really an end goal here. Having every duck in a row, everything in place to the extent possible that puts it forward to the investors, makes it obvious to investors that you have good advisors in place, you've been advised well, and you understand risk management.
Sounds like a part of building a credible picture that you're a serious player. Are there any stories, obviously identities that come to mind of somebody who maybe didn't follow this good advice and went to Google University for the legal documentation?
Absolutely. So many startups, they come to us, right? And they were trying to be lean with cash early on. They're not trying to spend huge sums of money on a CPA firm or a law firm or iBankers. Some even accelerator programs will go through and they'll sort of have one class on legal best practices or corporate governance. But that's not really enough to handle everything that needs to be handled just from formation. There's a number of things that need to be put in place that will put forward the impression to investors that you've done this correctly. This company has been run correctly since it was founded, and it's been run correctly in the interim months and years since then. That brings you to today's date. It's also really important that you build relationships such that you are able to be transparent with your advisors. So I'll have founders that come to me, they've been chugging along by themselves. They might even be accepting money on safes or convertible notes by themselves. They've never really touched point with a lawyer. And they're a little bit shy about it, or they're a little bit shameful that they're coming to us now and we need to do some cleanup work. But the reality is, the more honest you are with me about sort of what you've done in the past, the faster I can identify problems and triage it and ultimately fix it. But it is really important that you are honest with your advisors when they do come to the table, so they can help you clean up any things that maybe were done inadvertently, incorrectly, or Frankenstein's together.
I think that's a really important point. But before we jump to that, I want to see if you can give us a quick high-level overview. Like, let's say I know I'm going to hire a lawyer. I'll cover that in a second. I have to have all my ducks in a row, to your point. I know I'm going to get financing. What are those high-level things I need to have in place before I ever make my first pitch or talk to my first investor?
For me, I think things that are really important, again, I'm a lawyer, so my lens is through the legal and corporate governance perspective, even when I'm wearing my investor hat. But for me, formation is really important. I want to know that you understand what type of entity you formed. Some people form an LLC, some people form a C Corp. I want to understand that you understand the different implications of each of those entities and what your future plans are when it comes to hiring, what your future plans are when it comes to investing, because each of those entities will have different dynamics in play. You don't need to understand everything about the entire legal structure of each of those categories of entities, but I want you to understand why they're different and why you chose to form the way you did. I also want to know that your shares were purchased properly. So many people, they found a company, they go on the Delaware Secretary of State's website and they form a company, and then they just go out and they start running the company for years, but they never documented how many shares they own in the company or how many shares their co-founder owns in the company or co-founder number 3 and 4. And then maybe 2 years down the line, people decide that they don't want to work together anymore, or they have an incredible difference of interests, or they're no longer aligned in how to pursue this company. And then there's problems that come into play, right? Because it was never solidified who owns what in the company. And therefore, it's really hard to maneuver how to remove founders, bring in new founders, et cetera, et cetera. So getting those ducks in a row from the beginning, I think, is really, really important to do. And it makes your life so much easier down the line. Should there be a founder who wants to depart? Should there be a new critical advisor or executive team member that you want to bring in? It's a much easier transition to make.
This tells me really how important it is to get all of your documentation in place. There are other things too, as you mentioned, they go ahead for 2 years and get all of their things done. Sounds like there are some milestones too that I should be looking ahead as a founder. What would those milestones be, and what should I be cognizant of as I'm approaching each of these milestones?
Being really thoughtful and honest with your founding team about what the company's goals or milestones should be in 6 months from now, and a year from now, and 2 years from now will be really helpful in setting up the cadence and the goals that you're trying to reach, both from a legal perspective, but also from a growth and strategy perspective, right? You don't need to drain the ocean in just your formation. You want to be able to talk to your legal team and say, hey, I really need to do my first friends and family round in 6 months from now. What do I need to do to get that in place? Or I don't plan to do any hiring of employees that I need to pay for a year from now or 2 years from now. I'm just going to use independent contractors. All of those things are really helpful for your legal team to understand, because then we can pace out what legal work needs to be addressed and in what period of time. If you're not hiring employees, maybe you don't need an option plan in place, or maybe you don't need to worry about having good employment agreements available for you to use. If you plan to do a financing in 6 months from now, great. Let's talk about that sooner rather than later, so we can make sure you have a nicely populated data room that is easily accessible to your investors. It'll create more traction with your legal team and add more value when you're really able to articulate, okay, this is where I'm trying to be at month 6. This is where I'm trying to be at year 1, year 2, et cetera.
And one thing you raised there really made an impression on me, which is this point around what kind of financing you raised from what sources. I think one issue I've noticed is, especially as a first-time founder and you don't move in entrepreneurial circles, you're not really familiar with all of these types of instruments, sources. How does a founder get familiar with them? What are the challenges you've seen, and what are some things you've seen work well for a founder to get familiar with these financing vehicles and instruments?
Especially for first-time founders, it will be a crash course. And there is an element of it where, yes, you'll have a legal team that will coach you through it and can really give you the tools you need to go out and start selling the product, selling the idea, and bring investors to the table. But there's another element of it that really you can't do by yourself. Unless you've already had a company and sold it and seen the whole process, you wouldn't be a first-time founder if that were the case. But it can be very complicated. And I think that people, even people who do a really good job digging around on the internet, confuse and conflate the different versions. So I can give you a little bit of an overview. Usually part one of fundraising is what they call a friends and family round. So essentially you would go around to your closest friends and family. I mean, people who just support you as a founder are excited to throw whatever money they have at you to get up and running and started. It's usually a pretty frictionless process. That's the idea. Those investors are probably not going to ask too many questions about the company. The company's probably pretty early stage. You may or may not have even mock financials in place. Perhaps you have a model in place. Depending on the type of company, perhaps there's a prototype. Maybe there is a point of entry in the market you see. But usually those investors are just very happy to support you financially in whatever way they can. The general ways that they would invest is via a SAFE or convertible note. SAFEs are a document that you would find on Y Combinator. It's a standard, maybe 2-page instrument that's very simple to administer. There's usually 1 or 2 negotiating points, namely the valuation cap, whether there is one or not, and a discount. But that's kind of it. It's an easy, pretty frictionless way to get money in the door and shouldn't cost too much in legal fees. In fact, I have so many founders who go out and raise on a SAFE by themselves, and then later will come back and admit that they've done this, and then we have to do some corporate cleanup work. But it is a pretty easy way to go out and raise. The thing to know about SAFEs is it's not equity in the company right now. Those investors don't own equity in the company today, but it is a promise that in the future, when the company does and go raise what's called a price round or a qualified financing, at that time, the money that they paid for their SAFE will convert into a number of shares based on an algorithm of equity in the company. Similarly, and sometimes, depending if you're on the East Coast or West Coast, sometimes the next level of financing is on a convertible note. So similarly, this is not current equity in the company. This is a promise that it could turn into future equity in the company. A convertible note can work like a traditional note. There could be interest that's paid on it, and it can be repaid. There can be a demand of repayment in them. Sometimes they're a little bit longer. Sometimes there is additional legal fees involved with negotiating them and just kind of papering it because it's a little bit of a more complicated document. But on the spectrum of instruments and legal fees, it's somewhere in the middle. It's not a priced round, but it's not a SAFE, but it can have slightly more friction than a SAFE, but not too much, depending on the level of sophistication of the investor and where the company is at. Then the sort of dream of every founder is to be able to have a priced round. So you'll hear this called a number of different things. Sometimes it's called a qualified financing. Sometimes it's a Series seed round, Series A, pre-series, like there's lots of names that you could call it, but essentially, definitionally, it's the same in that the company sells its preferred shares of the company. It's a much bigger legal lift. There's more documents in place, right? When you are selling actual shares in the company to investors. What's exciting about a price round is exactly that. All of a sudden, the shares in the company have a price. Whereas leading up until this point, the valuation of the company and the value of each share in the company is a little bit of a fiction. It's not like a public company where every day you have a price of the shares that is put out there based on how they're being sold and bought in the market. A private company, a startup company's valuation and the shares of the company is really based on how much investors are willing to pay per share.
This is an amazing progression almost of how the founders proceed on their financing. At a very high level, what are the primary sticking points, if you will, on each of those? You talked about a couple of negotiating points. Like if you can just hit on the highlights of what are the sticking points that a founder needs to be careful of in each of these three methods that you laid out?
I wish I could surmise it in such few words. There's not really a quick and dirty answer around them. I mean, like I said, safes are meant to be the simplest form of instrument. And so usually the items negotiated around the valuation of the company and the discount that you get. This is not a true valuation of the company. It's really just a placeholder to but to dictate how many shares that particular safe holder will ultimately get for the price that they paid. It's an algorithm that works into a cap table, and it factors in a number of different things based on the company's current scenario. So there's not really a low-hanging fruit way to get you to those, what should the valuation be or what should the discount be. Similarly, with a convertible note, it's the bigger points are usually like what interest is being offered, if any, and then what the qualified financing amount should be. So the qualified financing definition is really when that convertible note will trigger into becoming equity in the company. So it'll say if startup company Y goes and raises $5 million in outside investment, at that point, this convertible note will convert into equity in the company. Those are usually the sticking points. There can be a number of other things. Investors, depending on their interests, depending on their own experiences or their level of sophistication, could come at founders with things like pro rata rights or most favored nation clauses or major investor rights. Especially in this economy, I'm seeing a lot of investors send term sheets across with asking for lots of preferential treatments, lots of customized terms that they would like included. And the founders just need to understand what those are, what they mean, and whether the check size is big enough to entertain them.
So all of this kind of really highlights for me how important it is for you to either be as sophisticated as you can as a founder, but more importantly, to have the right legal support to help you navigate all of these murky waters. So a couple of questions on that. First, at what point should a founder realistically hire a legal advisor? We all know that you get what you pay for, therefore good lawyers cost money, but founders are cash strapped. So what are your thoughts on when they should hire a legal advisor and how they should overcome this chicken and egg problem of I can't get funding unless I have a lawyer and I can't get a lawyer unless I have some funding?
It's a really difficult position to be in. And it also, I think, exacerbates the difficulties of being a first-time founder. You don't even know that you need a lawyer, where your peers who perhaps come from different backgrounds know right away they would never start a company without a lawyer, and they had one from day one. So my advice is always get a lawyer from day one. If not to hire, start talking to them, as many as you can. It's about educating yourself and it's about building relationships. I do believe, especially with early stage startups and first-time founders, it is as much a relationship business as it is a legal expertise business. Founders should feel empowered to go and shop around for lawyers and find the right lawyer that will become a trusted advisor and help them not only handle the technical legal side of things, but manage risk as the company grows and scales. You want a lawyer that is going to help you with as much strategy as they are around managing legal risk. So make sure you keep that in mind. Founders should also feel empowered to have early discussions around legal fees. There are so many law firms out there that are very excited to have the opportunity to serve an amazing company that is solving really novel problems in a unique space. And you, as a founder, should really feel empowered to say, hey, what kind of legal fees are you willing to offer a company at my stage? I expect to grow. I expect to bring in investment. I expect to be able to pay your legal fees down the road. But right now I can't. What kind of arrangement can we come up with? And if they're interested and if they are good at what they do and good at seeing the value and the potential for some of these early stage companies, they will come to the table and negotiate those terms with you.
Excellent. And can you offer examples of some common industry arrangements that you mentioned for early stage founders?
Sure. So every law firm is different. But again, you're not going to be the first founder that doesn't have any money to pay legal fees, right? So the typical sort of shame and dirtiness when talking about money, you're sort of implying that you can't pay bills, is something you should really shred. And you should really be able to say, let's figure this out, because I'm sure Google didn't have any money when they first started out as well. And somebody represented them. So let's figure out how this works. Fees to be aware of are fixed fees for particular projects, perhaps deferrals, give you a few months to be able to pay the amounts back. Repayment options, of course, is another thing. Sometimes law firms will take a cut of the company. So take like a 1% interest or something in the company. There's a number of different models. There's also kind of service provider relationships that you can think about through accelerator programs or those sorts of third-party relationships where perhaps there's office hours, right? Like perhaps you join an accelerator and you're able to get one-on-one time with a lawyer in that space, 1 hour a week or 1 hour a month. Like that's invaluable, and you should definitely take advantage of those opportunities.
What would you recommend? Let's say I have access to a relationship like that. Is there a list of like bullet points or topics that I should be taking advantage of in advance of going out and hiring a real lawyer on my own account, so to speak?
It really is back to basics. I think getting your formation right from the beginning is easy to do and something that most lawyers should be able to assist you with. So I would definitely hit on formation and post-formation items. So is the company properly formed? Is ownership of the company clear? Is IP protection clear? Putting consulting agreements in place, employment agreements in place such that the company owns the IP. Then part 2 is understanding your industry. Are there particular technical experts that you need to be bringing to the table, regulatory experts? Are you a digital health company? What does that mean? Do you need to worry about corporate practice of medicine? Are you a med device company? Do you need to be thinking about your IP portfolio? Yes, that's an expensive endeavor, but the value of the company is probably in the IP, so you need to hit on that first. So there's certainly nuances that will come up based on the industry that you're in, but I think you should be able to get a good sense of the lawyer and how sophisticated they are and whether they're a good fit for you by having a conversation around easy stuff like formation and post-formation work.
So that brings up a really interesting point, which is there are 2 aspects to working with a good lawyer. The first aspect, to your point, is clearly you know your domain. So if I'm in healthcare, or if I'm in whatever domain aspects of that law that you can help me with. But for women, there's another one, which is I may come to the table with a lesser or with a greater naivete, for lack of a better word, around what are the industry conventions around, for example, valuations. So in theory, you could tell me, hey, that's your job. I'm here to just advise, but that leave the founder holding the short end of the stick. How should a founder leverage the lawyer's knowledge of what's happening in the marketplace so that she doesn't get stiffed on valuation or any other part of the funding terms? And what can she do early on to know that she's working with someone who's not just going to throw legal agreements at her, but help her advocate a better deal for herself?
No, absolutely. And I think this is so important, so critical to my first 10 female founders is really feeling comfortable and confident in reaching out to me with any of these agreements that they get. Especially in this market, I've seen so much predatory investor or iBanker relationship such that these founders will get these emails, these cold emails that said, oh my God, I read your profile on the internet. It sounds so great. I would love to invest. Give me 10% in the company. I'll make all these introductions. It'll be wonderful. Or join my accelerator program. Give me 20% in the company and royalties moving forward. It'll be great. Like, you need to feel confident that you can call up your lawyer like you would call up your sister or your mom or your close friend and say, hey, what's your pulse on this? What do you think? Are you familiar with this accelerator program or investor or banker? Have you ever done deals across from them? Do you know anyone in your law firm that has worked through their accelerator program or whatever category it is? And be able to have candid conversations. I think the more industry knowledge and market knowledge and strategy that your lawyer can share in those early conversations around formation or sort of how you would approach the business model or strategy, I think it will become clear early on whether that person really has enough of a background in that early stage company space to guide you and strategize with you. If you find that you've aligned yourself with a lawyer that's not really able to help you think through these term sheets or negotiate better terms on these term sheets, that's fine. Go find another one. There's plenty of us rolling around, so you don't need to feel married to the first lawyer that you end up working with. I think it becomes pretty transparent, like which ones will be helpful to you as the company grows and which ones are live in their silos and perhaps aren't really going to advocate for you that way.
And as part of advocating or this advocacy element, to what extent is gender bias an issue that you're seeing with female founders in terms of their interaction with the lawyer? I mean, you could come to a position where you feel condescended to even by a lawyer. And if so, how do you find the right relationship or even identify a short list of lawyers where that's not an issue and where you can feel confident that you're respected as an equal, but a different expert as opposed to being an expert in the legal field? That makes sense.
I feel really strongly that female founders should feel as enthusiastic about the money they are spending on their lawyers as they would about any consumable good that they spent a lot of money around. If it were me, right, if I was going to buy an expensive fine leather good and I was going to spend my hard-earned money on it, I better be very excited about it. And I feel the same way for service providers like lawyers. If your lawyer is not responding to you in a timely manner, if your lawyer is being condescending or patronizing you when you're asking questions, I would feel very confident not working with them any further and going and finding a new one. There is absolutely no reason why a lawyer should not show respect and deference and build strong, close relationships with their founders, irrespective of their sex. It doesn't always happen that way. And I see a lot of female founders working with lawyers that aren't a fit. They don't offer them the same level of respect. They don't offer them the same level of trust and guidance. And it's better to rip that Band-Aid off and find a new lawyer that really will team with you and be part of your business strategy and your working group.
Just to push on that a little bit. So let's say there's a norm around valuation or a norm around a certain term in your term sheet. If you come across to me as friendly, but you're not really giving me the inside scoop that this is a bit off market, for lack of a better word, what is the test that I can use as a founder to know that you're guiding me right?
Yeah, that's a tricky one. I mean, because if you as the founder don't really know what is market, it's hard to say. It's hard to give you any guidance to tip you off that it's off market. What I will say is your lawyer should be able to explain every term in the term sheet to you and say, okay, well, this person's writing you a $50,000 check, and in return for their $50,000 check, they expect these 10 additional preferential terms. Let's talk through those preferential terms and let's parse through whether the value of the check that they're writing is worth those preferential terms. Again, the founder's in a little bit of a tricky situation because they don't know what they don't know. And it really behooves having great advisors who will say to you, hey, I know this investor and I know that these terms that this investor are giving you are not the best terms that they could be giving you. Or I just did a deal last week for a similarly situated company and the terms were very different. And I don't think there's that much actual difference between your two companies. I think having that level of candor with your lawyer is really critical. And if you're not getting that early days in the conversations, I don't know that you'll ever get that in that relationship.
And to that point, is it also fair to expect that the lawyer will advocate for you and negotiate on your behalf for more aggressive terms? When you're a founder, you need the check. I mean, let's be very clear about it. When the check is so close and there's a term sheet, the temptation is, let's just take it, we'll deal with this later. How should I expect my lawyer to advocate for me in that situation? And how do I draw that fine line to make sure I'm not pushing too hard, but at the same time, I'm not just like turning over and saying, okay, I'll take whatever you give me.
And that's another part of the relationship too. It's the delicate balance of both negotiating on behalf of the company and trying to get the most favorable terms that the company can get, but also following the money, right? Like not pushing the investor away so hard or putting such contrary terms into the agreement or into the term sheet such that the investor will not want to invest. Having a good lawyer in play, they will know how to delicately toe the line, and there'll also be reasons for towing the line. There will be reasons for saying to the founder, hey, I think you should accept these terms because ultimately they don't matter, or there's a very low likelihood that these terms will even come into play. You can similarly, if you have experience, you can similarly say to the investor, hey, investor, I don't think these terms are quite appropriate for a company of this size or of this industry or with this background, and here's why. Experience with so many term sheets and so many startups will make everyone more versed in the negotiation process. And it's not meant to be a battle or a knockdown, drag out fight between company and investor. You probably don't want a lawyer who is going to be in the boxing ring for negotiating. You really want a team of people in place that are able to be level-headed, business-minded, understand the risks, understand the concerns of the founder and the investor, and be able to translate between the two. Because ultimately, it's in everybody's best interest that the company gets cash in the door. So we want to help you get there, but make sure you're not giving away the company or things that you don't need to be giving away in the meantime.
And one last question, and I want to move on to the happily ever after the funding. And that question has to do with valuation. I read research that women get funding on lower valuation terms, and they also get smaller checks for a larger share of the company. What's your observation on this, and what steps can founders take to position themselves so the risk of this happening is lower?
It's absolutely true. You see it in the statistics and you see it in practice. I think the best thing a founder can do is acknowledge it. I think knowing that going into negotiating period and the period of fundraising, that they will have a harder time receiving higher valuations. They will have to collect more checks because the check sizes are smaller to get to that particular number that they're trying to get to. I think that will be the best thing that they can do to arm themselves. They'll be as skeptical as they need to be about the term sheets that come in the door. They'll understand the additional effort and time that will need to go into their raise, and then they can work around it. I also think understanding the inherent bias against female founders will open up opportunities to work with new investors that perhaps companies and early stage founders hadn't considered before. There are other opportunities to get access to cash from different investing pools. Then doesn't need to be the same sort of traditional players who are writing checks. You can go out and find a new set of investors and find a way to loop them into your circle. I think that will really help get them to where they need from a fundraising perspective, and also potentially bring new investors to their board, right? Not only are you selling equity in the company and getting cash in the door, but you're also bringing these investors potentially to the management table with you and looking for new blood and new expertise. Hopefully those investors are also women and can offer new perspectives and diverse perspectives. That way, I think will be really important.
Excellent. So now you've got the funding, the check has been cashed, it's sitting in your bank account. What does a founder need to know in terms of post-funding steps, things to watch out for, where they can expect their lawyer to step in and provide assistance and support?
Again, it's all back to the milestones, right? So, you needed this funding to get to this milestone. All right, so we've got the funding. We're going to use the money appropriately to get to that next milestone. Keep your lawyers in the loop, right? If you're having board meetings, definitely invite them to the board meetings. Let them understand how things are going, where the money is being spent. Help them understand what your needs are when it comes to additional fundraising, right? There's a lot of companies that are out doing bridge financings now, right? So they've perhaps already done one round of financing, maybe a seed round, but they need a little bit extra money to get them over to their next hump, but they don't want to sell equity. So they go back and they do a safe round or a convertible note round. The earlier that your lawyers know that, the more nimble and available they'll be to you when you need it. It's also great to have them looped in when you get new term sheets in the door. Some companies, they're not even shopping for funding, but they get term sheets and they need somebody ready to hit the ground running and negotiate that term sheet and potentially do a transaction for them. So it's important to keep your lawyers plugged in throughout. I know it seems expensive and perhaps burdensome, and you don't want to be running up the bill, but it's a whole different level of strategy and business acumen that I think is really worth the time and effort.
And on that, to what extent do you support kind of cap table management, and what should a founder be thinking about in terms of managing their cap table post getting funding and going forward, and how do you support that process?
We spend a lot of time on cap table management and coaching people how to use cap table management. But there's a lot of great tools out there. Carta is one that comes to mind. You should definitely be doing it before your fundraising because your investors are going to want to know sort of who's on your cap table, who you issued safes to, who you issued convertible notes to, is there an option pool, et cetera, et cetera. What are the terms of each of those tranches? It's really important to do that early on. I think that would be part of your formation conversation and just sort of ongoing good corporate governance formation, good corporate governance hygiene for the company. So it's definitely something really important and something we're happy to coach founders through so they know how to keep it done correctly themselves.
Taking a step back, we've kind of covered a lot of ground here. We've talked about instruments, we talked about steps, all of that. So if you had to take a step back, look at your experiences, especially with diverse women founders, can you summarize for me what are the top mistakes you see first-time diverse women founders make? What do you think is causing that and how they can better equip themselves to not make those kinds of mistakes?
Yeah. And, I want to be really thoughtful about thinking of it as a mistake because I don't want to send the impression that there's like sort of a paternalistic way of doing things, right? But I do think there's so much to be said about building your team of trusted advisors early on. As women, right? I'm a mom. I work a full-time job. I feel like I'm very self-sufficient and I can sort of do all the things all the time by myself. But I need help. We all need help. And understanding and recognizing where our skill sets start and end, I think it will be really important to the growth of the company. And similarly for founders, I think that surrounding yourself with people who fill the gaps in your knowledge and your experience is critical. And the earlier you do that, the better, because they can help you avoid potholes. Perhaps you build a whole business strategy around a product that's really not going to work from a legal perspective or a regulatory perspective. Perhaps you have a fintech company that wants to sell a particular product, but actually that's not possible in the current regulatory regime, right? But the founder's already gone out and sort of made pitches under this product, et cetera, et cetera. So building those relationships, making those connections with advisors early on, I think I don't want to say it's like a mistake not to do it, but I think there's nothing but a value add to spend the time and effort doing it from day one.
Got it. And along those lines, building on that, if you had to say, here are 5 things in terms of best practice that I'd recommend you do as a founder before you ever start fundraising, what would those top 5 do's be?
Clean documents, making sure your formation documents are correct, signed, dated. Make sure your purchase of your own shares of the company is correctly done. You paid for them. If you needed to file an 83B election, which is like a technical tax issue, just make sure your formation was done correctly. It's obvious who owns the company. It's obvious you bought your shares in the company. Protecting the IP in the company from day one. So making sure you have good employment agreements and consulting agreements in place, I think is exactly where you need to be. Leading up to a fundraising is thinking about a data room, right? So your investors are going to want to poke at the company. They're going to want to know certain things about the company, business plan wise. They're going to want to know, do you have commercial contracts in place? What do those look like, right? So talk to a lawyer, think about what a traditional investor will want to see in that data room, and then have a data room populated. Then work with a lawyer to make sure the term sheets that you're getting in the door are, if you're going to consider them, are negotiated well. There's connectivity between the company and the potential investing team. Really understand and think through what the implications are for having this investor invest in the company, right? There will be different implications if they're writing a check via a safe or a convertible note. But if they're a lead investor in your Series Seed round, you need to understand that they potentially are going to join your board, or potentially they're going to be a stockholder that you need to go out to every single time you're trying to do something material to the company. So really understand what you're getting yourself into with each kind of upcoming round of financing and what it means.
Excellent. This has been a very thorough and comprehensive conversation. Is there any question that you wished I had asked, but I didn't?
Oh gosh, I can't think of one. I know you asked me this question in our preview, but I can't think of one. No, this has been great.
Fantastic. So thank you so much for this conversation. I have learned a ton. I know our audience will as well, and I'm sure we'll come back to it over and over again as the reference manual for all things legal. So I appreciate it, and thank you for everything you're doing for women and diverse women founders as well. This has been a pleasure.
Thank you, Shubha. Thank you so much. This is so great, and thank you for all the hard work you're doing as well.
What I liked most about my conversation with Elke was the unique blend of legal caution and the business and investor point of view that she brought to the table. So, what were my big takeaways? First and most important, the more free information there is on the internet, the greater the illusion that you think you know the answers, and therefore the greater your risk as a founder. Real-life data and professional expertise become more and more important the more information there is outside. And for that, you'll always need a skilled professional. Don't rely on Google for legal advice. Second, her walkthrough of the legal journey was really helpful. First-time founders rarely have a clear picture of what to expect during a raise, but have to jump in feet first anyway. You typically don't have a lot of choice. Knowing what to expect ahead of time pays. Last but not least, my favorite part of the conversation was Elke's advice to women to listen to their gut in selecting the right legal professional. You are the buyer, you're paying the bill, and you have every right to expect your lawyer that she not only help you with the legalese, but also gives you the real-world insight on how your term sheet stacks up against what's standard in the industry for your sector as well as for your stage. So, use head and heart and also your eyes and ears to make the right call on which lawyer you'll work with. It will impact your financial position far beyond the size of your legal bill. So, what one step will you take to tighten up the legal side of your startup? Thanks for listening to today's episode. We have show notes and more at achieve.co. That's achiiv.co/podcast. Like what you heard? Hit subscribe and share with a friend. See you on the next episode. Now, go be an achiever.